I'm here now with Paul Merriman. Paul, thank you so much for being a repeat offender on our podcast and coming back. I think this is our third or fourth year. Really excited to end 2024 with you as we have the last few years. So thank you so much.
Oh, it's great to be back, Rob, and I hope this is a tradition that lasts for decades.
Listen, I hope so. I hope both of us are here for decades, but we'll see. Paul, we've talked about so many various different things, and I get so many positive reviews of the times that we've had you on the podcast. So it seems like people in my field of congenital cardiology are finding our conversations very useful. As you well know, having been an advisor for many decades, doctors are woefully uneducated about a lot of this stuff. So I think as little as we're doing together here and have done, people have found it of great value. And thankfully, also, many people have asked me for the links to the download for your free books. And
Great.
also, I have more than one colleague who now listens to your own podcast. So thank you very much. Paul,
Terrific.
I thought what we would do to start off today is take a slightly different tact and ask, how do you think an investor should think about how much they actually need to retire? In other words, as John Bogle once asked the question, what is enough? How do we know if we have enough to retire?
You know, Rob, interesting you bring John Bogle up because when I met with him in 2017, he was kind enough to take 90 minutes out of his life and we compared notes and by the way, he gave me some advice that I have taken. And it's made a huge difference in my life and the work that I'm doing. But
Yes.
it is part of that conversation was about his focus on enough, because that really, as you know, he wrote a book entitled Enough.
Yes.
And he really is focused on people having enough, being able to retire and have enough to meet their cost of living. And of course, as all of us who are looking at making these retirement decisions, we know that we've got to take inflation into consideration. So enough isn't just for today, it is also for some assumed inflationary rate we have to deal with. But I will say this, that the difference of opinion that John Bogle and I had is I am not trying to help people have enough. I
Hmm.
really want people to have more than enough. And I don't say that having to do with greed or anything that's distasteful for people who hear that somebody wants more than enough. No, I want people to plan on more than enough, because how many times in our life did we have a plan and it didn't come true the way we thought it was going to happen?
Hmm.
And so I believe if we set out to have more than enough, maybe what we'll end up with is enough. Now, the traditional enough typically is kind of focused on Bill Bengen's 4% distribution rule, so that enough in theory, if you want to not only take out a certain amount now, but you want to adjust for inflation, the probabilities are over 90% that if you take out 4% and you adjust for inflation, that you will in fact have 30 years worth of income. You might not have much left over.
Right.
Well, I know each one of us has kind of some personal feelings about what's left over. Some of us want to think in terms of money left over so that others will benefit from our hard work and diligent saving and investing. And that doesn't have to be all about family. I know in our particular family, everybody knows that my IRA does not go to my spouse, does not go to my children, but goes to Western Washington University, where we
Yes.
are helping to underwrite a financial literacy for all program on the campus. So each one of us has this set of desires that we have for what we want the money to do. But I will tell you this, and I think this is huge. We set out in having more than enough to have at least twice what we needed.
Yeah.
And just to put a number on, just pretend that what you need is $40,000 a year from your portfolio, which if you're going to go with the Bengen 4% strategy means you need $1 million to underwrite that 40,000 plus adjusted for inflation in the future.
Yes.
Now, by having twice as much as we needed, it meant that now not only did we not have to worry about inflation, because if we got 2 million instead of 1 million, but we only need 40,000,
Right.
it really means not only do I not have to worry about inflation adjustments unless they're really unusual situations,
Right.
but that I can take out 5% instead of 4.
Right.
So with 2 million needing 40,000, I can take out 100. And guess what that means? More money to give, more things to do if experiences cost money and you want to do them. I really think that is a legitimate thing to do as a goal, is to end up with, in essence, way more than what is enough.
I guess the problem with enough is we never quite know what enough is going to be because we don't know what our future is as we grow older.
And Rob, that's really an important point, because we don't know what inflation will be.
Yeah.
We don't know whether we're going to retire at the bottom of a bear market. If we have our mindset that we're going to retire when we're 65, and all of a sudden we're at a market that's like 2002, where the technology stocks just dropped 80% over the previous 3 years, and the S&P 500 is down 50%. We don't know where we're going to retire in regards to where the market will be, what inflation will be, and we also have no idea what surprises are going to pop up that we need to fund that we didn't plan to fund, like helping a grandchild that your kids just can't handle whatever the expenses are to solve whatever the problem is. And
Yeah.
so it's again, having more than enough is really a huge luxury. And that may mean for many of us that we work longer than we anticipated, because we want to have that luxury of having more than enough.
Right.
And the good news is, I was doing something that I didn't mind working until I was 70.
Right.
And in fact, after I retired, I went back to doing the same thing for nothing. So I love what I'm doing, but not everybody's that enthusiastic about the work
Right.
they do.
Sure. And I think physicians increasingly are less enthusiastic for things that have nothing to do with being a practitioner or a clinician, more related to the politics of work and the all of the different ways in which we're measured in our work. In medicine, there's something called the dreaded RVU, or relative value unit, where they keep very close
Mm.
tabs on exactly how much effort you're doing. And I think a lot of older physicians, particularly, are bothered by this because it seems to be the only value, or one of the most important measurements by which doctors are judged in the United States, at least. And so it's the terrain is changing, or I should say, at least medicine, as most doctors are practicing it today, is a fair bit different than it was, I think, when they were in medical school. So I do think that I'm probably speaking for a lot of physicians in that some of them at least are thinking about possibly retiring earlier than they might have initially in their careers.
Yeah.
Um, but I think that it also points to the explanation for why you're always trying to help people figure out a way to eke that 1% more out of their portfolio, right? Because if you can do that, then the imperative nature of working longer becomes less important, right? If you can actually earn just a little bit more on your money.
And that's a really big deal, Rob. People, smart people don't get the impact of compounding over time at small additional amounts of return. And one of the great things is that many of the things that are eating your return alive, like high expenses or high taxes, or there's any number of things that can cause the return to be lower that really have nothing to do with the market, but
Yeah.
have to do with the way that the investments you have are set up, and to the extent that you take the steps to control those things that you can absolutely control. I mean, you can control the turnover inside of your mutual fund by being in an index fund instead of an actively managed fund.
Right.
And anybody who pays a load to buy a mutual fund anymore, I just want to encourage them to, when you're about to do that, to sit down and write Paul at paulmerriman.com and tell me that you find yourself falling into the trap of wanting to buy this load fund from somebody who belongs to your church. I am here to help.
Yeah, yeah. I mean, just for those in the audience who may be less familiar, though I'm guessing most do understand what Paul's speaking about. Some mutual funds are so-called loaded funds, and those are funds where you actually have to pay a premium for the quote-unquote honor of being able to invest in that fund. It's often sold by financial professionals, in part because they get part of that commission. And although many of those professionals profess the fact or suggest that those funds will do better than simple indexes, the evidence is overwhelmingly the case that those funds do worse. And even if they do as well, they on average do worse because you have to pay the extra load. And so there's almost no level in which that makes any sense at all, especially in the present era where there's so many inexpensive, excellent products out there. Paul, it brings up, and you brought up the idea of index investing, and particularly, I wanted to talk a little bit about the S&P 500. So most
Hmm.
people, I think, when they think about investing in an index, are investing in the S&P 500 index, which, as you know, is the largest 500 companies in the United States. Typically, it's based on their the value, the size of the companies, with the larger companies having a higher percentage of the index. I'm wondering if you might speak to the audience about why you love the S&P 500 as an index for people to invest in, but what are some of the disadvantages? And maybe you could speak to how we could maybe combat the few disadvantages of an S&P 500 fund.
Well, that's a great topic, Rob, because most people have got their money, their equity investments in the S&P 500 or something very similar to that. As a matter of fact, the total market index since 1928, the difference in return between that and the S&P 500 is 1/10 of 1%.
Hmm.
And so whichever one you're in, you are getting, as you alluded to, a cap weighted portfolio that the very largest companies, maybe 50 to 100 companies, are going to move most of the profitable aspects on the way up. And by the way, they will likely lead on the way down
Yes.
as well. And so the pros are, and the reason I really like the S&P 500 a lot is because we have a lot of emotional hurdles to deal with as an investor. And one of the things is, I believe, that people have a sense of trust around the S&P 500, that it's not a matter of a bunch of fly-by-night people that here today and gone tomorrow that could leave us somehow holding the bag.
Yeah.
But in fact, we have got a piece, and I think it's about 85% of public corporate America in that 500 companies. Now, that's the good news. And by the way, it is a portfolio that is built in theory forever. But that's not what's really going to happen, because every year they go in and they tweak it, and they might remove 20 companies, which means that to have the 500 companies still there, they're going to add 20 companies. So at the end of 10 years, you've turned over about 40% of the companies. So this is not like it's a buy and hold forever, no matter what. They do make adjustments. But
Yes.
what we do know is that asset class, driven mostly by large growth companies. Yes, there's some value in the S&P 500, but most of the big money, like right now, if you look at the tech stocks selling at in the case of Microsoft over 30 times earnings, in the case of Tesla, you're almost 120 times earnings. Those companies are having a huge impact on the total return, and that's normal.
Yeah.
This is what's fascinating. Studies have been done by Dr. Bessembinder is the one I know best, going back to 1928, where they determined that 4% of the companies were responsible for most of that 10% expected compound rate of return.
Yeah.
One out of 25. The other 96% on average have compounded at 3%, the rate that you would have gotten in T-bill rates. So
Hmm.
there's no question these really successful companies. And by the way, at one time they would include Sears. At one time they would include General Motors. It's not like because you get on top, you get to stay there forever.
Right.
Uh,
Right.
and so right now we know who the so-called forever companies might be, but they will not likely be forever. And so it's a great, trustworthy group of companies
Yes.
and a minor amount of management. Having said that, there are other asset classes that are not really included in the S&P 500, like
Yeah.
small companies, like mid cap, like value small, etc. And so what we know is when you add other equity asset classes to the S&P 500,
Yes.
the risk does not, depending on how we want to measure risk, the risk does not go up, but the return does.
Hmm. Okay.
And so the question is that a smart thing then to do to go beyond the S&P 500? You know something? It's not the smart thing to do if you're not willing to stay the course when whatever these other equity asset classes are doing isn't good. And the S&P 500 is the best, and you don't have all your money in the best, and you want to have all your money in the best. Well, then
Sure.
you're not going to be diversified amongst these different equity asset classes. And if I could encourage your listeners, Rob, to look at the quilt chart that shows the year by year returns of the four major equity asset classes, and it shows the return of the average building a portfolio of all four. You are going to see that the return goes up by over 1.5% a year, and you're going to see that there's way less volatility with the four of them than with the S&P 500. And one thing we got to keep in mind about the S&P 500, it is going to follow the way that investing works, unless investing no longer works the way that it has for forever. And that is this: the lower the risk, the lower the expected return. We
Yes.
all would agree bonds, lower risk, lower return. Stocks, more risk, higher return.
Yes.
With the S&P 500, because they are the highest quality companies in the country that are public, it means that it is expected to have a lower rate of return than small cap and small cap value and large cap value.
Yes.
And so when you take the S&P 500 as your only investment, equity investment, you are taking an equity asset class that is very dependable. But from time to time goes down 50%, Rob. That's an important thing to know
Yeah.
about the S&P 500. But
Sure.
but the fact is that you're not going to have the best returns unless we turn investing, the beliefs about investing, that if you take more risk, you make less. No, you have, if you don't make more for taking more risk, you're doing something wrong, because
Yeah.
that's the way investing is supposed to work. But you know something? 10% compound rate of return for most people in the equity part of their portfolio without having to worry about adding small cap or value. There's nothing wrong with 10.
Sure, that's great.
But every extra 0.5% that we can help investors find, whether you are entering retirement with a pot of gold or you're just getting started with nothing in your pot, that extra 0.5% can mean an extra $1.5 million easily over a lifetime. And so, boy, I work hard to teach college kids how to find an extra 0.5%. And I believe, and that's what our book, We're Talking Millions, is about. There are about 12 decisions we make, and each one of them is one of those $1 million decisions. And
Yeah.
they're easy, all easy.
Yeah, and I think it gets back to the first thing we were discussing, Paul, that about what's enough. And basically, what you're saying is that if you make just one of these 12 things, particularly the idea of leaving the S&P 500 or at least adding to the S&P 500, that could be enough to make you make more than enough and then
Yeah,
put you in a much better position later in life. And Paul, you had mentioned the four asset classes. Could you just elaborate a little bit for the audience on what you mean by that? One of them
oh,
is
sure.
large cap blend, which is represented by the S&P 500. Wonderful fund. What are the other asset classes that you feel would ideally be in a diversified portfolio?
Sure. Let me just make one comment about that blend, that term blend. That's
Yes,
a blend of growth and value.
yes,
But by far, the greater impact is the growth part of the portfolio.
sure.
Now, if you take the growth out and you held just these large companies that are out of favor. Now, what do I mean by out of favor? Well, for example, if you looked at the S&P 500, the compound rate, I'm sorry, the price earnings ratio is about 22. Now, many of those companies are way above 22, and some of them are below. But if I take out all of the growth and I'm left with just the, again, we're going to call them out of favor because people aren't willing to pay much for their earnings. That
Yes,
price to earnings ratio is a 12 to 13 times. So they don't, the blend is a combination of both growth and value. But when you take the growth away, you're left with a slightly more risky portfolio and slightly higher long-term return. Now, the other kind of asset class are smaller companies. Those companies in the S&P 500, I think the average size company is $200 billion dollars is a big number.
right.
On the other hand, when you're in a smaller company fund, the average size company might be three, four, five, maybe even 6 billion. They're not penny stocks. They
Right.
are just small companies, either on the way up or the way down. But they act as a group different from the large. And one of the things you'll see about that quilt chart I mentioned, as you look at each year, and it's color coded, so you can see the S&P 500, it's bright red, and you can
Yes,
see the small cap value, it's electric blue,
right.
but it is amazing how wide the disparity is in returns when you look at these four different asset classes, large blend, small blend, large value, small value,
Yes.
the average difference from the between the best of those four each year and the worst is 15% a year,
Wow.
which means the S&P 500 could be making 30% while small cap value could be making 15.
Which is kind of like this year, actually.
It's true.
Yeah,
Yes.
yeah.
And you see that we make a mistake. We look back and think we can make sense of the past. But the reality is, and this is the only quote that I think I've ever actually made, by the way, nothing new about it, but the quote is basically this. There is no risk in the past.
Hmm.
We always know what we should have done. And so when we go through a year, we know where we wish she had been. As a matter of fact, maybe at some time during the year you even said, "Gee, I should sell that small cap value and put that money into the S&P 500." But wait a minute, Merriman says don't market time, don't be bouncing around, don't second guess, because more people hurt themselves than help themselves. But that is the nature of our view is we understand what we should have done.
Right.
I know I got married at 19, Rob, and I can tell you I should have gotten therapy when what am I doing getting married at 19 to begin with? But then was I prepared for it? No. I we needed couples therapy immediately.
Right.
But you know something? So many of us think anything that is so simple as just living, you don't need a therapist, you don't need an expert on investing. You can see what's happening. No, you cannot see what's happening. You can
Yeah.
see what happened.
Right. Right.
What's happening is totally unknown.
Right. Yeah. Yeah. Good points there. So, and for those of you interested, we've previously discussed the benefit of adding something like small cap value, which is one of the asset classes that Paul espouses a lot in many of his works. And I'll put a link to last year's podcast. And also, the last year we spoke about this novel approach, which he refers to as two funds for life, which he developed with Chris Pedersen, in which one takes a target date fund and pairs it with small cap value. Again, another mechanism of adding diversification and adding that asset class that could be very meaningful over long periods of time and improving the outcomes of one's returns.
And,
And
and
yeah,
Rob, if I could suggest one other link,
sure.
boot camp. Boot camp gives uh, about nine big questions, and it gives an answer in a video, in an audio podcast, and in an article, and with tons of tables. So
That's
for people who really want to dig and become a proficient, by the way, you'd almost know enough to be an investment advisor. I really encourage people to go through the boot camp. It is free like everything else that we do.
okay. And again, that's on paulmerriman.com, and I'll put a link to that in the show notes.
Thank you.
Paul, you talked a little bit about this just now, but I'm wondering what are some of the psychological hurdles that we all face, and how do you suggest we manage them? I was just thinking this year, and we alluded to the fact that, I've been following what you've been recommending, but this year having some money in small cap value, although not a loss, has dragged the portfolio marginally versus some other years. But I've listened to things you've written and read what you've written and read other authors, and so I'm confident that long term this will be the correct solution. But how do we manage our own psychological hurdles? What are the hurdles that we face, and how would you recommend managing them? The most common way I manage it is just not looking at the portfolio, but I'm wondering if you could offer some advice.
Yeah, and I don't look at my port. I have no idea how much I made last year. It doesn't matter. I just don't look at it like that. But I understand that some of them look at it daily, hourly. But here's the interesting thing about the psychological hurdles. There are actually about 48 biases that we live with.
Mm,
And they all have in some way can reach in and manipulate our decision making.
yeah.
A famous book, Thinking Fast and Slow by Daniel Kahneman, is 500 pages. The first 250 are readable and enjoyable, and the last 250 are all the research, and most people won't get into those. But I will tell you this, one of the three directors of our foundation, volunteers, those folks are volunteers. He wrote a book called Spending Your Way to Wealth. And in the back of that book, he has the Kahneman 48 biases down to about 16 pages.
Okay.
And the book itself is about how to deal with those biases and very specifically those biases. But
Mm.
here's I think the best steps. One is do everything you can to automate
Yeah.
the portfolio. And in a sense, you automated looking. You're not going to look. So that's good. But
Yeah.
it starts with saving. So Warren Buffett says, don't save what's left over after spending,
Yeah.
but spend what's left over after saving. Now that's an automatic. That means that before you spend anything, you're putting money into your 401k and you're not stopping it because you're having to sacrifice some of the fun things you'd like to do because your commitment is making sure that you're preparing for the future.
Yeah. Yeah.
And so that's an automated and dollar cost averaging, automated
Yes.
using index funds. I look at index funds as a kind of an automated way to invest. You're
Yeah.
not trying to figure out, okay, who's the best manager for this year, or for this decade, or for the rest of my life. You just get on board with the index fund, and you know what you're going to get. It's the only guaranteed return in the
Right.
equities market. It may not be a good return, but you're getting the return of the index itself. And you said it earlier, Rob, that index return, only about 1 in 10 to 1 of 20 actively managed funds are able to do better than the index. So how easy is that to be amongst the best? That's one of the few times in your life that you can, with kind of no risk, be in the upper 10% of all the people.
Yeah.
And so you automate all the things that you can. And the reason that it's important to make sure that you've done all you can is because then you can trust that the rest of what's going to happen to you is simply going to be the direction of the general market over a long period of time. And all of the history says, yes, we go through bad times and you must be prepared for them, because if you're not prepared for them, you're going to find yourself wanting to bail out when the market is down because you're afraid. And I know that we all know this is being a little bit crazy, but we're afraid it's going to zero. We're
Right.
going to lose everything. We're having that self talk. And so we have to do everything that we can in building our relationship with these investments based on knowing there are things we can control and we have controlled them. I am not letting Wall Street manipulate me.
Yeah.
I mean,
Yeah.
in a sense, it's we're not going back to that. We're
Yeah.
going to make sure that we take advantage of all of the efficiencies that have been built into the market. Then you trust it, and then you just keep doing it over and over and over. But you got to understand that in fact you have not done the best in your S&P 500 that you could have, Rob. You could have been in a fund that only has the top 50. Why
Hmm.
are you in 500 companies when you could have been in a fund that's the top 50 and you would have made a lot more money?
Right.
And the reason would be, well, because that top 50 historically, when it gets beat up, it's not unusual for it to lose 80% of its value. And I don't want to be there when that happens.
Right.
I'll just add one other thing about this, making sure that you really, in essence, approve of everything that's going on in your portfolio. I'm 81. My wife's a few years younger than I am. We're not going back to work.
Right.
And so I'm willing to have half of our money in equities, kind of growing for the next generation and for Western Washington University. But it isn't to feed us and to house us. That could be taken care of with the 50% that's in fixed income.
Right.
And so each one of us should figure out what is that combination of equities and fixed income that gives us the return that we need and a level of losses likely to be sustained that are livable, are okay. That, well, they're never okay, but that's what you're going to have to face if you're going to be that much in the equity market. And as you know, we build tables. In fact, you
Yes.
get them in the boot camp. We build tables that show people, okay, if you're 60% in equity and 40% in bonds, what's the risk? What's the return historically? We look at every 10% difference so the investor can really put their finger on the trip that they're likely to take.
Yeah.
And if you're ready for the trip, I'm not a doctor, but
Hmm.
every time a doctor goes into a surgery, it's got to be there's an unknown aspect of it that I don't particularly understand, but I do know that things can go wrong.
Sure.
And pilots have the same problem. The plane stops working somehow. And so how do we fix it? Well, we probably don't fix it by making up things for the first time. We fix it by knowing, being prepared. It's the same thing with your portfolio. You need to understand what it is going to do for you, what it's going to do to you, and remember that you are in the greatest business that ever existed when you own part of the S&P 500. You got 500 companies going to work for you every day. The employees, yes, there are a lot of crooks in those 500 companies. There are a lot of lazy people in those 500 companies, but they're all going to work and hopefully putting in a reasonable day's work and then working to make you a dividend or make you the stock value go up. It's a business, and
Yeah.
you are the senior partner.
Hmm.
Well, you're certainly the senior partner in the early years when you're adding money to the portfolio. Later on, they're making the big money, and the money you're putting in is relatively small. But it is a partnership, and people need to understand that partnership needs to be managed.
Yeah, and I think that there's this tendency that we all have, especially people who are educated, to feel that if you work harder at something, if you do more research, that you can do better. And so I think that's how we get fooled sometimes into active management and funds that are not automated in the manner that an S&P 500 fund would be or a small cap value fund would be managed. And this is one of the few things I think in the world, or in adult life, where actually working harder at something doesn't necessarily result in a better outcome. It's actually how much you can automate and just go with the simplest solution that strangely is actually associated with the best outcomes.
It's exactly how it works, and it's in a sense one of the big hurdles is that you have people who think they are smarter than the market.
Yeah.
And so in essence, what you're saying is there are uh, there are 50 million people who have put their heads together, but I know better. And
Yeah.
there's no evidence that people do. As a matter of fact, one of my favorite books is Jason Zweig's Your Money and Your Brain. And when you ask people how much money they've made, they'll give you a number if they think they've kept track of it. And then they actually go in and study those people's returns, and they have way overestimated the returns that they got. They didn't make as much money. As a matter of fact, most people think they've beat the market over time. It's not true.
Right.
It can't be all because all investors are the market, and so and investors are optimistic. Not only are they smart, but they're optimistic, and they think they're better than an average driver. We've all seen these kinds of studies, and we're a better parent than average, and we're a lot of things that we're better than average, but in reality, maybe not so. And those are traps.
Yeah.
And yet it almost feels like you're giving up to say, okay, I'll take the S&P 500, whatever it gives me. And that's not very good, but I could be doing a lot better. I could be in cryptocurrency. I mean, we
Right.
we talk silliness, and yet it is just the nature of humans.
Well, I think it goes back to a concept that I always espouse when I'm doing procedures on patients, which is that sometimes the enemy of good is better. And I think in a similar vein, I think that we are always looking for something that is better, but it turns out that good is really pretty darn good, and in fact is better than most things that are touting themselves as being better, and especially when it comes to personal finance. Well, Paul, I really can't thank you enough for joining us this week on the podcast. It
Thank
is
you,
just
Rob.
such a delightful way to reconnect and to end the 2024 year. This is going to be for those in the audience, we're recording this just a few weeks before the end of the year, but this is going to be the final podcast of 2024 for Pediheart. And it's become a great annual tradition to have Mr. Merriman on. And I found that people find him of great interest. I certainly have. So I want to thank you, Paul, and I want to wish you and your family a year of health and
Thank you,
happiness
Rob.
into 2025. And I'm going to force you to commit to next year, 2025. We'll be back doing it once again this time next year.
You got it. If my brain is working, I'll be here.
I'm sure it will be.
Oh,
So
and my mouth, and my mouth.
thank you so much, Paul.
Thank you,
Appreciate it.
Rob, and Happy New Year to you
Thank you.
and
This
yours.
same to you.